Well, my next guest says that there's a deja vu going on in the markets now. To explain and give his insight, let's bring in David Dahl. He's president and CEO at Keneally Trust. David, thanks for joining us this morning. And let me get your idea of what that deja vu is.
Well, Monica, it's great to be back with you. Let me quote that great American philosopher, Yogi Berra, with it being deja vu all over again for the markets. Back in mid-August, roughly to the day, around August 16th, we had a whole lot of volatility. We saw a bottom formed with hedge fund redemptions 45 days before the end of a calendar quarter. In this quarter, it's going to be a year-end quarter as well. But 45 days out is when we're getting redemption notices for folks that are going to be looking to pull funds out of hedge funds. And we've seen those fiduciary investors, some foundations, endowments who might not have known exactly what they had invested in. They got caught up in the eye-popping returns, and now that returns are maybe not as eye-popping, we're seeing them start to look to pull cash out. And this is setting up a timetable again here in November, where we've got right up till November 16th will be the 45-day mark before December 31st, and we've had the exact same type of volatility we experienced in August.
Yeah, looking at a chart just of the S&P and seeing some of the moves that we've seen in the last 6 months even for the market, you're saying that we're hitting a midpoint just coming tomorrow, as a matter of fact. Do you think that'll help the markets calm down, David?
Well, it did back in August, and if history's our guide, it's going to do again so for us. You know, volatility, especially what we see late in the day. We've seen a market who is regrouped here this morning, but really until we get to around 2 o'clock, that's when volatility has really picked up over the last few weeks, and that's exactly what we saw in late July and early August. Markets accelerate because there's a lot of trading that's going on as those funds that are getting redemption notices are starting to clear their decks and getting ready to pay it out. It's our view that when we get past that, beginning next week and in the weeks that follow, we're going to get a settling, just like we saw back in late August and early September. And then we're going to be able to talk a little bit about economic news, not so much about who's the latest company to provide us with the biggest write-down.
Let me get your sense, David, as well. What other evidence are you seeing that, in fact, the markets are sort of with a near-term positive bias?
Well, you know, Monica, what we got to talk about is what's getting lost right now is all the economic news. Some might call it mixed, but you know, we've had some pretty good jobs numbers here recently. Maybe this morning's figure showing jobless claims moving up was something that we'll keep an eye on. We've had tame inflation ratings. You know, the CPI isn't really even the measure that the Fed's going to pay attention to. Even if we looked at that running on a core basis at 2.2, the PCE is at 1.8. We're underneath the Fed's desired target range there. We think the Fed's got ample room to continue to cut, to provide for liquidity into the marketplace and forestall any impact to the economy from what's going on in housing and subprime. So the economic news is generally pretty solid. It's just getting lost in all of this subprime and credit issue stuff.
Dave, you know, I want to touch on oil because we'll get inventories in just a couple of minutes, about 15 minutes or so. You think that oil prices are going to come down. Interestingly enough, the OPEC president out today, and he, in fact, was saying that the price is now potentially dangerous. Do you agree with that?
Well, his statements about high prices being dangerous just because there's a lot of issues, both dollar related to that and then potentially geopolitical. They're also looking at the fact that, you know, as consumers, we're dynamic. There's already been evidence that's come out about consumption changes here in the U.S. At 22 million barrels a day that are getting utilized, we've seen changes in consumer behavior. The simple changes from buying SUVs to mid-sized cars and what that does to fuel economy. $100 per barrel oil is a nice sounding figure, but we believe in the dynamic impact of substitution economically. And for us, that means that at some point, consumption does start to wane, even if it's because our economy's slowing. And with that, then oil prices start to recede.
David, we have to leave it there. Thanks for the insight today, David Dahl, Keneally Trust.